you can have a great life and good bucks instead of huge bucks but a terrible life. If you do 20% per year in 3.5 years or 4 years or something, you'll still double your money easily. If I get a 15% compounded annual growth rate, every 4.7 years, I double my money. And if I, at the same time, I can get my drawdowns below 10%, I sleep so good. I think risk is the most important part to be aware of in trading by far. The key thing is that you want to stay in the game. If we have a strategy that has an edge, that we can make money, our biggest risk is that we don't have any chips left to actually execute our strategy. As long as we have chips left because we look at our risk tolerance, then we look at the longer term outcome. What I've seen, what happens a lot is that people have a blend of strategies. What they do is the strategy that tests the best, they allocate the most money to it. Don't do that. Don't do that. Because if that strategy turns out to not be performing in the future, it will have the highest negative impact on your account. If you as a trader understand why your strategy is not working and when is it supposed to actually not working, then you can actually live through those times in drawdowns. Drawdowns is a part of our life as traders. We need to deal with them. We are more times mostly in drawdowns than that we're making equity highs. Don't have 17 different rules and 5 different exit mechanisms and stuff like that, but try to keep it simple.
Hey everyone, welcome back to another episode. As always, we bring top traders, US investing champions, and market wizards here onto the show to share their journeys, their strategies, the mistakes they made throughout their careers, and key learnings that they want to pass on to you guys to save you time, save you money, and improve your performance. We've been lucky enough to hear back from many viewers over the past few years about how much of a positive impact this podcast has had on their trading journeys, and we're incredibly grateful for all the support. If you're looking for a free, quick, and easy way to give back to us and show us some goodwill, please double check that you're subscribed down below. And if you aren't, go ahead and click that button. And with that said, thanks again for your support, and sit back, relax, and enjoy. All right, welcome back everybody to the TraderLion podcast. I'm your host, Richard Moglen. This episode is brought to you by DeFi Charts. Check out the link down below in the description to learn more and to check out the newly released DeFi AI features. Joining us today is Lawrence Bensdorp, a systematic trader with over 2 decades of experience who currently trades over 55 non-correlated systems. And actually, as of this recording, it's now 75, he just told me. So he's been hard at work since the last time we chatted. Lawrence co-hosts workshops with Tom Baso, who's featured in Market Wizards, and is the author of 3 books, The 30-Minute Stock Trader, Automated Stock Trading Systems, and Trading Retirement Accounts. He was also featured in Van Tharp's Trading Beyond the Matrix, where he detailed his transformation from a discretionary trader into a world-class systematic trader. Today, we're going to cover a lot. We'll focus on how he designs and tests strategies, integrates them along with all the other strategies that he runs, and hopefully come away with a lot of tangible lessons that we can apply to our own discretionary style. So Lawrence, first and foremost, thank you so much for taking the time and being here with us. And it's great to chat with you. Welcome.
It's my pleasure, Richard. Thank you for having me.
Of course. To start with, I'd actually like to take it to the very beginning because we actually didn't touch on this too much the last time we talked. How did you first get interested in the markets and, get into trading and then eventually evolve into a systematic trader?
Okay. It was back in the year 2000. I was actually running my own Whitewater rafting and adventure tourism company in Mexico. And I got a call from my father. He had a small boutique venture capital company that was in big trouble. He had crooked accountants, very bad advisors and everything, and they were bleeding money both on the venture capital investments, but also the equity investments were terrible as well. And he said, Lawrence, I need somebody who I can trust. And well, since I obviously indirectly was involved in that money as well, I said, okay, sure, I'll come over and help out. So there were two parts in there, the venture capital part and the stock trading investment parts. And the venture capital part was so incredibly bad that my only job was basically to help liquidate everything and lower risk as much as possible. The stock trading part was immediately the part that completely grabbed my attention because I saw, okay, so I could actually choose stocks that will go up in value and make money. So that was my first literal experience with it. I had zero education regarding this, absolutely nothing, but a good brain and a lot of commitment. And this is how it started. And at that time, the stock trading investments were managed by a high boutique bank in the Netherlands, who basically had a buy and hold approach. And one of the first things I decided against advice from the banks and everything, and we're speaking here April, May 2000s. So you know the time, the dot-com boom was over, everything was going down, and I said, okay, we're gonna need to de-risk. I don't know what those stocks are doing. This is what we have right now. At least make sure that we maintain this capital and then make a normal analysis to see what we actually can do with it. So for the next years after that, we maintained flat the portfolio, and I studied a lot about fundamental analysis and stuff like that. But it wasn't really what I liked. It wasn't really where I could find an edge for myself. So I started to read the books from Market Wizards, and the first two books, Market Wizards and the New Market Wizards, there were a lot of systematic traders in there. And that really caught my attention, like, okay, so you actually can have a complete systematic trading where the computer makes the decision for you. So that was something that really suited my style. I saw that a lot of people had made millions and billions of dollars using that style. So that's what I chose to become specialized in. So I read every book that I could get my hands on, which at that time was a little bit harder living in the Netherlands than right now. You can get every book on Amazon right now. At that time, it was a little bit harder to find it, but was a very interesting path. It eventually led me to 2007, where I had developed, with the help of outside programmers and some retail software, 4 different strategies. And I started trading that in 2007. 2 were long and 2 were short selling strategies. That's, in a nutshell, was the transition from running an adventure tourism company to becoming a systematic trader.
You're the first whitewater rafter turned trader that I've interviewed, so that's
I think
special.
so, yes.
Yes, for sure. Yeah, there's a lot to dive that I want to dive into today. First, those initial strategies, the 4 different strategies, what were the basic parameters that you were looking for? What was the edge that you're trying to capture with those basic strategies? And how did you decide on those 4 to start with? And we're going to go all the way from this initial strategies to what you're doing now. So, but I think it's really
It's a
interesting
long road, yeah.
It's a long road, but it'll be interesting to see how your process is developed, how much more
Yep.
depth you're able to think. But yeah, bring me back to those first strategies. What were kind of your goals with those initial ones?
Both were, so the 4 strategies were mean reversion strategies, too long and too short. Basically on the long side, where you look something that is very oversold, you buy it, and then you wait until it reverts to its mean. That specifically at that time really resonated with my personality. I was a lot younger, and strategies like that tend to have a holding time which is not that long, between 2 and 5 days maybe on average, and have a high win rate, which is what at that time was something that I was very, very interested in. I did have the same philosophy on the short side as well. So you look for overbought stocks and you sell those shorts and you wait until they revert to its mean and then you buy them back. Now that was a very interesting time to start because it was mid 2007 and all went fine. Then in August, you saw the first kind of big tensions in the markets already. So there I started to understand drawdowns and stuff like that. And then came 2008, obviously. 2008, my mean reversion systems on the short side obviously did phenomenally well because it was a typical bear market that was violent, a lot of volatility, a lot of pullbacks to the upside that I could
And
short.
breakdown. Yep.
And so it was a very comfortable start for me during that time. And that continued until 2011. I had a very comfortable start with that. I increased the numbers of strategies, but only mean reversion, because at that time I already said, okay, I could have one strategy that has a certain algorithm, but it might be having times where it's not working. So if I have another one that is designed with some different parameters, I have some diversification. But then came the 2011 August sell-off of the market, where within, I think, a week or so, I think the index lost between 15 and 20% or something. There was some kind of Fed decision. I can't remember what. I don't look at the fundamentals. The only thing I look at is to make sure to follow my systems. But at that time, the only thing I saw that I suddenly had a drawdown that was probably more than twice as long and large as my simulated drawdown until then. Now that, by the way, is something that is totally normal in systematic trading, but I didn't know that. I didn't have a mentor or somebody who could teach me and say like, okay, it's fairly normal that your drawdowns could be larger. And I was like, my goodness, this is incredible. How did this happen? So I started to look at my strategies and why they actually lost money. And what I saw at that time, that obviously the long strategies all lost money because the market sold off in a panic. And then it doesn't matter if you're diversified with 30 or 40 different stocks. If the market is in panic, generally
correlations go to one.
goes in lockstep, all bam goes down. So at the same time, my short selling strategies were not in the market because the market went momentum down. There wasn't a pullback, so I couldn't short it. So that made me realize, okay, it's all cool that I have a combination of different systems, but I do need momentum systems as well, both on the long and on the short sides, that when the market really falls in momentum like that, that I have a way to capture that momentum to actually protect my account. So from that part on, I started to expand my portfolio of strategies, and with every strategy that has a different purpose for a different kind of market type. Volatile markets, non-volatile markets, choppy markets, markets with huge momentum. And that's when I really started to expand it all over the place.
Yeah. And now I assume you also are trading many different markets as well, not just equities, not just crypto, and you diversified that way as well. You're trading many different asset classes and all that, and that builds the resilience of your system, the robustness of your system. Is that right?
Absolutely, absolutely. I think until 2019, it was still mainly equities. I have a lot of strategies already trading at that time, but since that time, especially after my friend and seminar partner Tom Baso kept hammering on me when we had a call. He said, "You need to trade futures. You need to trade commodities. There's a phenomenal edge in there." And I finally listened to him and started to implement those in 221, 222. I wish I would have listened earlier because 2020 was, especially for futures, a very interesting year, but it was a little bit too late with that. But right now it's almost 50-50, I would say, as far as futures and equity. Definitely also because I think that the commodities part is both on the long and the short side such a phenomenal diversifier. I mean, we've had in the equity markets, obviously since 1995, we've had a huge upward bias. There have been bear markets, but there has been a very upward bias, which you couldn't see that much on the commodity side, which obviously were doing phenomenal in the 70s and the 80s. And what you kind of see right now is that having that commodities part laying over the equity part brings a huge amount of diversification with all the stuff right now that's going on the geopolitical part, obviously. Having been and currently still being long energy, obviously in 2025, I was long all the precious metals. It came to an interesting end on the 31st of January this year, as many people know. But a big part of that was basically giving back profits of things. And yeah, so it's a lot more diversified, but also on the equity part, it is a lot more non-correlated as well.
Hey everyone, just want to jump in here real quick and let you know that this episode is brought to you by DFU, which is the platform I use every single day to find new trading ideas, monitor existing positions, identify new leading themes, and analyze the markets. You guys deserve a platform that keeps innovating and brings you the most up-to-date tools to trade the market. And at DFU, almost every single week, we're launching a new feature or system update. Here's what makes DFU different. The screener comes loaded with preset screens from actual market wizards and top traders. So you're starting from the setups that the best in the world actually use. And when you're flipping through results, you've got mini charts right there, so you can visually scan through hundreds of stocks all at once. That alone saves me so much time every single week. The charting is built for how we actually trade. Multiple timeframes, unlimited indicators included anchor VWAP, enhanced volume, custom indicators like RMV, and the built-in RS rating. You've got custom dashboards to track the market, themes, and real-time sector rotation, so you always know where the money's flowing. Best yet, we just launched the DFU AI terminal, which brings all your research into DFU with easy-to-use preset prompts or your own custom ones. You can even identify gap catalysts with just a right click. We set up an exclusive offer of 1 free month for all TraderLion podcast listeners. So to activate your trial today, check out the link down below in the description or visit dfu.com/podcast. That's dfu.com/podcast. And with that, let's get back to the interview. Yep, perfect. And I want to dive deeper into how you build one strategy and think about it as a whole. But before we do that, I did want to call back to how you first got your inspiration, reading the market wizards, studying those traders who are trading systematically. Were there any traders who really stood out to, you really ingrained, what they were speaking about in the books and to your beginning studies and still to this day, think about their principles? And also, were there any other traders that you study? A lot of people might know Jim Simons, the Renaissance Technologies Fund. They did a lot of systematic, a lot of short-term stuff. So I was curious if there are any other kind of influences for you that kind of helped inform how you trade and develop strategies today.
I think obviously the people from the Turtle program, although there wasn't that much revealed about many of them in the Market Wizards book. There's actually a chapter, I think, "The Silence of the Turtles" it's called. But there was an interview of Bill Eckert, Richard Dennis, and I think, I mean, if you read kind of those war stories where somebody turns $2,000 into 200 million, that's when you're young, that really
Catches your
yeah,
attention. Yeah.
that's what you want to do, that's what you want to have, right?
Right.
So that was a big inspiration. I didn't understand at that point yet the complete risk of it. Once I started to trade and develop things more myself as well, I did see as well that the stress that can go paired with trading, especially if you have an oversized position sizing algorithm. And the chapter that's with that part resonated most with me was in the new Market Wizards of what is now my friend and seminar partner Tom Baso, because what he wrote is or what Jack Schwager wrote is like basically you can have a great life and good bucks instead of huge bucks but a terrible life. And I said, yeah, that's actually something that I'd like, because the law of compounding will do the rest for me. I mean, if you do 20% per year in 3.5 years or 4 years or something, you'll still double your money easily. And if you can maintain your drawdowns, that is something that is incredibly important. So I started to model my mental states and my mental framework according to everything that was in that chapter from Tom Baso. Not the strategy so much. I was never that interested in exact strategies from other people. I think it's very important that we all have our own strategies. We can learn as far as philosophies of what people do with certain strategies, but I always like to have my own strategies. But to me, trend following was just trend following, where you basically, your main objective is you're hunting for an outlier. You're hunting for that stock that you buy at $10 and it moves to $50 and then you get stopped out or whatever.
Yeah, and I really like what you said there. I've had multiple traders on the show who have had heart attacks, have had health problems. These are people who were very successful, but over decades, it takes its toll. So I think what you said there is really important for everybody to remember, is that trading is a high stress game. And depending on your strategy, there's going to be more stress, or you can optimize for different things. So I think that's really important to remember. And you right now, you're traveling, you're able to manage your systems in not too long each day. And still do
Zero
all that
time,
work.
actually.
Zero time.
It's basically it's running on a virtual server, all my strategies, and I've got my own software that generates the orders, my own software that executes the orders as well. It connects with my broker platform. So, and I get an email then from my software that says if all the executions are correct. So theoretically, I do not need to open my broker platform on a daily basis, which is by itself, I think, very often an edge as well, because having a look at your broker platform and seeing that P&L on the left side of your interactive brokers accounts, and you see it going up and down like that. And when you start to have a larger account, those swings are getting bigger, and it's not necessarily that helpful anymore. Although very often it is said it's so great that you can have instant feedback of how you are doing. Well, that's actually your biggest enemy, I think.
Yep. So you're saying the 30-minute stock trade is a misleading title. It's actually the 1 minute, that the 0 minute stock trader at this point.
I still think I would say it's good that you revise everything. But when I
Yes, of
wrote the
course.
30-minute stock trader, I didn't have the execution software yet. I had at that time working somebody for me who actually was placing the orders for me and needed to report to me. But yeah, if you don't have execution software and you have like 6 or 8 strategies, then possibly within 30 minutes a day, you can just take a look if everything is placed automatically and done correctly, and then close your broker platform, go and play golf, and in the evening have dinner, and in the morning before the market opens, take a look, place your orders again. I like to have that part automated as well, because I basically live in 3 different places worldwide. I really like that. It's the lifestyle that I designed, that I always dreamt of. And if then everything is on full automation, that really helps a lot.
Excellent. That's the goal for sure. Perfect. Well, Lawrence, I want to dive deeper into developing a fresh strategy. And by the way, I just want to mention to everybody, Lawrence gave an excellent presentation at our conference breaking down a lot of this process. So we're going to go in a little bit, different direction today, but definitely review that if this is something that really interests you. And it was a great Q&A at the end as well. But Lawrence, first and foremost, I'd love to say, or ask you, where does the inspiration for a new strategy, say you're trying to come up with your 76 strategy currently, where do you look for inspiration? Is it reading about other traders and what they're doing? Is there a hole that you've noticed your current batch of strategies kind of doesn't fill? Where do you typically come up with that first, idea for a new strategy that you might add to your portfolio?
Couple of things. I think the first thing, I always take a look at the blend of strategies that I have, and if there is a possible weakness for a certain scenario, a possible market scenario that could come up and that I have not pre-planned for. That is something that there's always space where I can take a look and I say, okay, well, let's take a look. Over there in 2018, things didn't really work out that well. Why was that? Was there a flaw in my blend of strategies? If so, was that flaw random? Or was it actually conceptual flaw that I could attack with another strategy that is specifically designed to make money during that week period? So that is always a big thing. Obviously, with so many strategies that I have right now, that part is getting less and less. I think another thing that is very important is actually thematic things that are coming up. Like right now, we're in a geopolitical situation that is tense, right? Which is something that from a psychological standpoint of view, nobody likes. But as a trader standpoint of view, I look at what opportunities could rise there for me. So then I would say like, okay, you want to build a mental framework and a concept first. Like, okay, there's possibly a scenario where we could be for several years in war and crisis and stuff like that.
Right.
So what kind of stocks could theoretically do well? And let's call that for now aerospace and defense stocks, right? Then I say, okay, I need to have a good portfolio that has both listed and delisted stocks in that specific sector so that I'm not looking for hindsight and survivorship bias. And then I start to test and what I want to see in those tests. So I develop a certain set of rules. It's all built in my software already. And I wanted to see to make money when it is supposed to make money, but I also wanted to see to lose money when it is likely to lose money. So with a long-term trend following system on aerospace and defense stocks, for example, in 2008, when there wasn't really a lot of that geopolitical tension right now, and there was a huge bear market as well, I'd like to see that there is a significant drawdown in there, because otherwise I'm just
You want to
fooling
see the
myself.
drawdown, right? Exactly.
Exactly.
Yep.
I want to see it. But then at other times, I want to see specific, very outsized returns as well. So I think the thematic thing is something that is very easy actually to develop. And the same goes with commodities. It is something right now that is a theme that more and more people start to be interested in. So what do I do then? Okay, you can create a portfolio of, let's say, ETFs on gold, on silver, on crude oil. There's decent, good ETFs on that. And you can widen that portfolio as well. I present a strategy on that in my last book, Trading Retirement Accounts. And what you want to do then is you want to create simple rules that say, I want to be in those commodities when they are start to trend. That's a very simple trending rule, which could be something like the close of the ETF is below the 150-day Bollinger Bands +2 standard deviation, or a Keltner channel, whatever. And we exit on that same Bollinger Band -2 standard deviation, basically measuring that there's no trend or the trend is over. What you will see then, if you simulate that, this is important. You will see that if you only look at compounded annual growth rate and maximum drawdown on the sample size that we have, maybe an 8% compounded annual growth rate, 40% maximum drawdown. And people would say like, well, what's that? Why would I like to have that? Well, first of all, it's how does it fit in
Into
the
the
big
system.
picture of your suite of strategies? How does it fit in the current geopolitical environment that is going on? But also take a look at when those strategies actually make money. 2008, it really helped the bear market, the first part of it. 2022, the bear market, again, the first part, commodities long strategies really helped the bear market over there when all the trouble in Russia and Ukraine started. At that time, it was more the grains and stuff like that that really moved up. And then we had obviously 2025, where there was a big boom in gold and silver and everything. And who knows if that will continue this year? We don't know. Price will tell us.
Yep. So just to kind of emphasize what you're saying, your goal, your objective is to find strategies that not necessarily in of themselves have the most amazing, it's guaranteed triple digit returns and great drawdown, but it fits into your overall process where it's going to perform when the rest of your strategies or the majority of your other strategies are not performing as well. And that coupling, that putting together of all those creates a more robust and actually, I think improves performance as you showed in the
Yes,
TraderLion presentation. So that's what's key. You're not just trying to find the most higher return system. It's the one that fits in and works when maybe the rest of yours that don't work as well. So that's kind of the nuance
exactly.
there. I think that's really interesting. Um, yeah. Did you
It's
have anything
it's
to add
it's
there?
key actually because I think 99% of the traders, they develop a strategy and they expect that strategy to work all the time. But I think every strategy will have 2, 3, or 4 years where it's not working. Now, if
Yep.
you at the same time have another strategy at that time that is working, then you can continue to compound money instead of having only one strategy that is for a longer period of time not working, and most likely people will suspend it then.
Yes. And I would say, speaking to as our audience, our style is discretionary, but our general strategy is long momentum. And that works best after significant corrections when the markets start trending and things are working above moving averages. But in the recent 3, 4, 5 months, it's been a choppier up and down market. And for our style, it's best to be participating very small if you're trading, be in cash, or trying something else like a more mean reversion type setup. But
Exactly.
it I think regardless of whether you're a systematic trader or a discretionary trader, recognizing when your system is performing well, when it's not going to perform well, that's absolutely key, and that fits into your long-term longevity of your performance as a trader.
Yeah, I think if you as a trader understands why your strategy is not working and when is it supposed to actually not working, then you can actually live through those times in drawdowns. Drawdowns is a part of our life as traders. We
Yep.
need to deal with them. We are more times mostly in drawdowns than that we're making equity highs.
Yep.
Um, and if you know why that is, then it is very easy to deal with it. But also, it gives you an opportunity to take a look. Okay, what am I missing? Is there something else that in a certain market environment where my current stuff is not working, to have another strategy that has a possibility because it is so different in design that could
Right.
make money.
And when you say different in design, does that mean it might use different indicators? It might be trading a different time frame. What are kind of the levers that you can push and pull to make a strategy more uncorrelated from another one? If you get my meaning.
I think the main thing is that you want to have a design where you focus on the fact that one strategy is not working. Why is that?
Hmm.
Okay, if it's a long-term trend following strategy, then you want per design, not a long-term trend following strategy.
Right.
It might be a short trend following strategy, but the most likely thing would be something opposite, like a mean reversion strategy, for example,
Hmm.
which is specifically designed to actually make money in choppy markets. Or if your long-term strategy, your long-term trend following strategy is not working, you design a short selling mean reversion strategy that is specifically designed to attack the risk in those time periods where the market goes down. So that is how it basically starts. You look for the weakness of a certain strategy, and then you make sure that during that specific weakness, the new strategy is kicking ass. That's
Right.
that's that's what you want.
Yeah, and let's actually dive deeper into that exact example. What would work well in choppy markets? Because that I think is almost the inverse of what us as trader, on this channel are most about. So in an environment where the indexes are chopping around, they're correcting, there's a lot of gap ups, volatility is increasing, there's gap ups, gap downs, there's new stuff going on, impacting price. What kind of strategies would you test out to see if it would complement, what you would normally be doing?
Mean reversion would be the first thing. But not only mean reversion, because obviously when you have gaps up and gaps down, it could also move against you. What you could do as well is short-term breakout strategies, for example. And this is very counterintuitive, because when you test those strategies by themselves, they're not that good.
Mm-hmm.
But again, it's when are they making that money? And if they're making that money during that time period where you have a sudden up move, it captures that move, but then it gets out.
Right.
Then you have something that is designed to make money in those choppiness. It could be a band trading strategy as well, which is at the lower side of the band. It starts to turn over, which is kind of a blend of a mean reversion strategy. And then you buy it basically. Because at that time, your long-term trend following strategies mostly have been stopped out. They're choppy and everything. And then in that middle part where it keeps kind of choppy in that band, then you kind of have a strategy that tries to capture that part.
Yeah. And as you're testing something like that, what data points are you looking at to say, okay, you're on the right path, you investigate that a little bit more? So data points, and also, are there any visuals that really help you kind of understand that strategy is working when the main strategy, isn't as well, other than maybe an equity curve drawdown graph? That's likely something that you use as well, but are there any other visuals that really help you visualize competing strategies and how they might complement each other?
You really want to take a look at the equity curve, but in a very different way than what we are used to, because what we are taught that we want to see a wonderful 45-degree equity curve.
I want 65 actually. I want 65
right
degree.
up or right. That's like the dream. But what you want to see in something like this, you actually want to see a very weird equity curve. You want to see an equity curve that excels in those time periods of choppiness, but at other times where your trend following strategies are making a lot of money, then I would expect that new strategy actually to lose money. So you really want to look at that part that you see a big spike up and then it's not working anymore, big spike up. But then the thing comes, and that is obviously that I have in my own simulation platform, where I can simulate 75 or 150 strategies at the same time, is to actually combine those strategies and actually see how the combination of those two strategies, if it actually does what my hypothesis was for the combination of those two strategies.
Right. And one question I did want to ask you was, obviously data quality is everything with this, to be able to get and trust the results that you're getting. What data feeds do you currently use? What would you kind of recommend to somebody starting out as maybe not a super high cost, but still pretty high quality data set that they can get pretty good results on, if they're just getting started with systematic strategies?
Norgate data. Have you heard of them?
I have, yes.
Yeah. I think Norgate data, it's interesting. They're located in Australia. And they have very high-class US data, both on listed and delisted stocks. Everything on a daily basis, all the delistings are adjusted and included as well. It is also compatible with a lot of different software packages. So it integrates in my platform completely automatic through their API. So basically, as long as I have Norgate installed, it feeds automatically the data into my software. It has dividend data in there as well. And I think their customer support and the owner, they're really onto it. And data is such an important thing. And I think there's starting packages, I'm not sure about, probably $500-600 a year or something. I would always recommend to do that and don't go for free data, because that free data, if there's one little mistake in there where they forgot to have a split in there, then you can have an issue. And you see that a lot with free data. There's a huge amount of mistakes in there.
Yeah. And again, from the mindset of somebody just getting started, obviously you have your software that can simulate really well. What would be the best place to go for someone newer at this, to start testing strategies, to start looking at the results? What kind of software or tools would you suggest they check out?
The data, as I said, and then it really depends on what your skill level is, and what your budget is as well. I would say from a complete low end to a high end, I would say the low end, but skilled, like let's say you want to start with $20,000, for example, have your data feed and then try to program yourself in something like Python or something, which is freely available, for example. I think that is the cheapest option that you have. Then the high-end part would be, for example, in my mentoring program where the software is included. So it's the same software that I use, where you do not need to code at all, because I cannot code, by the way. I cannot write a line of code, but every rule is basically programmed in, so you can just drag and drop and select what you want to do. And then immediately the focus shifts from focusing on one strategy in the code, but it shifts to focusing on multiple strategies and expanding.
Right. And for someone who maybe they're getting starting with the Python version, what would be some really good basic strategies to try first, to just kind of get used to analyzing equity curve, analyze performance? Are there a few that come to mind just for people to try out first, to basically learn how everything works?
I would say long-term trend following on stocks, long-term trend following on a portfolio of commodity ETFs. So you don't need to deal with the programming of futures and everything, which is a little bit more complex, obviously. And do that on the short side as well. Short mean reversion strategies. So I think if you have those three, then you have a very decent way of getting started. And then you can start to diversify with your trend following strategies. You can have a strategy on the S&P 500, one strategy on the NASDAQ, one strategy on the Russell 3000. Then you can start to look at different time frames as well. Like what I do, I have strategies that look for a 20-day look back on a trend filter. So a 20-day Keltner channel, all the way up to strategies that have a look back of a 250-day Keltner channel. Why is that useful? A 20-day Keltner channel at the bottom of COVID would have gotten in very fast, and you would have been able to ride that whole move up. A 250-day would have gotten in very late. So the other thing is, it's important to keep it simple.
Yep.
Don't have 17 different rules. and 5 different exit mechanisms and stuff like that. But try to keep it simple, because especially with trend following, the only thing that you look for trend following, you look for a trend and you want to stay in that trend until it bends, period.
Yep.
So portfolio is important, obviously. If you select to trade NASDAQ stocks, you're going to have generally a better backtest. You're going to generally have more volatility as well than if you say, okay, I use S&P 500 stocks, but I have a filter in there that I only trade the lower volatile stocks of those. Nothing wrong with that either, but it depends what your preference is.
And you mentioned obviously the 20-day look back and then the longer term as well. Do you have intraday strategies as well, or it's mostly a little bit longer time frame, longer term signals? Obviously the 20-day can be pretty short, but do you focus more on longer time frame signals than short term volatility movements?
I focus on end of day data.
Mm-hmm.
But I do have very short-term strategies. I could actually, you could have day trading strategies that are based off end-of-day data and then enter the next day, but close the same day on the close. Totally possible, but currently as we speak, I don't use intraday data. There's a whole other level of complexity and data quality issues with intraday data as well. But I have many strategies that are very short-term focused actually, and others that are medium and long-term. So I'm all over the place basically.
Yep. Cool. And then this is more of a hypothetical, just to kind of hear your thought process. But there's an edge that a lot of traders of our style trade, which is like a gap due to great earnings that surprises everything. It causes a gap up of 10%, 20% in the stock, and then playing the kind of trend that can happen after that. And sometimes they go right away. Sometimes there's a little bit of a pause, consolidation, tightness, and then they start trending. From your perspective as a systematic trader, what would be your thought process to kind of try to capture that edge and create, like you said, a simple but robust system that could look to capture some of these gap ups that might happen, again, due to earnings, which is more cyclical, but also there's the news event that maybe there's a partnership with NVIDIA or something like that that causes another gap up. So I'd love to hear kind of you break that problem down and how you would approach that.
So I think as far as the earnings, I don't take earnings into consideration, but so it's not part of my filtering process, but very often I still will be in those stocks. And I think what often happens with earnings is indeed two things. It gaps up and it continues to gap up, or it gaps up and then it starts to fill the
Reverses.
gap. Mm-hmm. For both, you can have strategies actually to say, okay, the stock has gapped up that amount of money, or average to range, they'll put it in that way. You buy that stock and you trail it. The same thing could be the stock gaps up that much, you sell it short and you have a stop loss, let's say 10 or 15% above it. I think both ways are actually possible and actually have an edge.
Interesting. And how would you kind of decide sizing, because there might be a lot of stocks that gap at once. There might be just one or two. How would you kind of take that into account and size appropriately between the different opportunities that the market is showing?
I would always say, and this is just a simplified example, right?
Yeah.
If you have $100,000 and you only have one strategy, which I wouldn't recommend, but just for this purpose, right? Have 10 stocks that trade a maximum of $10,000. That means that sometimes you only have 3 or 4 stocks that are actually in there. But if there's no other candidates that have that statistical edge to be in that position, then you shouldn't be in it. anyway. So then I say only trade those that are a candidate for you to trade and to have the possibility of making money. Then obviously you can have more advanced position sizing, like volatility-based position sizing, where you risk a percentage of your account, let's say 2%, but also max that out at 10%. Because sometimes if you have a percent risk strategy and your stop loss is very small, that could equal into like a position that is 70% of your account value. That is not really necessary and what you really want, because things can gap against you as well overnight, and then the pain is definitely big.
For sure. And one other question I had prepared is, between your 75 strategies, is it equal allocation between each of them, or are you or do you have more of your total account value dedicated to one strategy versus another? And if so, how do you kind of decide, okay, this strategy is going to be, maybe it's one of 75, but it's going to be 5% of my account is going to be focused on that strategy, and I'm going to trade with that. So yeah, walk me through your process and how you allocate capital between each of the 75.
Yeah, it's a great question, because what I've seen, what happens a lot is that people have a blend of strategies, and what they do is the strategy that tests the best, they allocate the most money to it. Don't do that. Don't do that. It's a classical mistake, because if that strategy turns out to not be performing in the future, it will have the highest negative impact on your account. So as a general rule, I allocate the same amount of money to every strategy. There are some exceptions. I do allocate a little bit more money to ETF strategies than that I do to equity strategies. And that is for the basic reason that ETF strategies do not have the individual corporate risk that individual equities have. So if I have a short trend following strategy on the S&P 500 as a catastrophe hedge, I allocate more money to that because, yeah, shorting the S&P 500 and when the market then goes down makes a lot of sense. There's not a lot of corporate risk in there because it's based on 500 stocks basically. But if I have one strategy that is actually trading penny stocks, that one is definitely a lot more volatile, and there you want to be careful, obviously, to not size it too high. So generally speaking, try to do everything equally, but if there is a specific purpose like a hedging strategy that is based on ETFs, then you can increase that, or the same with commodities, because there aren't that many.
Yeah, makes perfect sense. And let's say you came up with strategy 76, and you're on your way to 100. How would you still put an equal percentage in that new strategy that you're committing real money to for the first time? Or is there like a temporary period where you're seeing if it's working, you're seeing if it's acting correctly, that you kind of give it less capital just to kind of see in real life situations, how's it performing in real time?
Nope, I completely, immediately allocate the amount to it that it should have according to my whole suite of strategies. And the reason for that is I should know already beforehand what the objective of the strategy is, when it is supposed to make money, when it is likely to lose money. So if I put it out of sample and let's say the first 3 years it doesn't work, well, maybe it's not supposed to be working. So it's all about the combination of the strategies. And if I see that I have developed a strategy, for example, a new strategy that is specifically designed for a volatility spike. Market is quiet and suddenly, bam, volatility goes through the roof, market sells off. That strategy by itself won't test very well because you don't have every week or every 2 week volatility spikes.
Right.
But you did have them obviously in August 2011, August 2015, 2018 a couple of times, COVID, then we had July 2024, the first couple of months in 2025 as well.
Yep.
And then suddenly they spike up like that, but you don't know when that's going to happen. But those strategies are just waiting on the sideline. They have an active order on a daily basis to be executed once they exceed a certain price, and then they're in. And that basically protects me from the downside as well, because when those volatility spikes happen, most of the stocks are going down. There's suddenly panic. Maybe Trump said something or whatever it is. But then you want something else that offsets that.
Yep. And you mentioned earlier about, if you're just starting out, maybe you don't have the execution side automated as well, and you might have to check in each day and prepare orders for the next day. And I think I've talked to Tom Baso as well, and that was a process that he followed for quite some time. For automating execution now, which is what you have set up, are there any additional things that you've had to think through, outlier cases that you have to make sure things will automate correctly? Any mistakes you made initially when you're automating execution that maybe you can share with us to hopefully prevent some heartache for folks in the future? Anything on that kind of the equation, that side of the equation?
It's a long road in which I, on the development part, have not been involved because that is what my business partner does, Alexei. He's brilliant in that part. And we have a team of 3 other programmers that are looking for that, because you have software from your brokerage platform that has an API that basically can connect and everything. Those things get updated as well and everything. So there's a lot of nuances as well, but it also depends on the complexity of the strategy that you have. If you have one strategy with 2 rules and a market on open order, then it is a lot simpler than when you have 30 long strategies and 30 short selling strategies. And possibly there could be a time where, for example, your blend of strategies says in total buy 100 shares of Apple, but there's also one strategy that sell 20 shares of Apple.
Right.
Then you need to net that out to 80 shares long. If you don't do that, then the broker says, okay, this is not how it's supposed to be, so we're going to cancel the second order, which is obviously not what you intended to. And then the day after, the software needs to look at what you have in your broker platform and what it is, what you're having supposed to be, and then there comes an adjustment order. And that's what you need to be prepared for as well, for all those adjustments orders. So if you can prevent that, that's a lot better. But it seems a quite simple road in the beginning, but there's a lot of nuances to it, and it's basically, I think, also ongoing development as well. Because broker software changes as well. You want to make sure as well that the broker that you work with actually has decent software to have that connection between your software and their brokerage platform. Because some brokerage, they're just more retail orientated, where people buy a basket and they have 15,000 different graphics to show about your performance and everything. And then you have the other spectrum, which is a lot more professional, and for the professional trader that focus more on data integration and software integration and stuff like that.
Yep. And you use IBKR, is that correct? That's the main broker that you use, or
Interactive
yeah.
brokers. Yeah.
Gotcha.
I think that they're good as far as their automation. I think they're good as far as their fill prices. Short selling availability is good. Commissions are good. Anything else? Customer support is, let's put it this way, it's not their strongest points.
Yep. And then obviously, recently, which can help folks who are just getting started with this, who maybe are technical with the coding side, AI has made some amazing advancements in the ability that if you know what you want, if you're able to logically describe a strategy, for instance, it can kind of create that for you. I was curious if you have incorporated at all AI in either to the ideation side, the research side, or if you've kind of created any strategies themselves, using AI to help kind of finalize the logic or any aspect of the rule set.
So in a recap, I think AI incredibly helps to speed up any kind of process that you're working with, whether it is research for a portfolio, whether it is coding. But what people do need to understand, that it is something that will speed up things, but it's not that AI is suddenly going to beat normal traders and stuff like that. AI does not know what the price is going to be of the stock tomorrow, but for increasing your processes, so all our programmers, they use AI for their coding, for example. If I come up with a new idea, or I am thinking about a new idea, now I use AI to speed up that process. And it's phenomenal how good it is with helping you with idea creation. But the input is what most matters with AI. If my input is bad, if I say to ChatGPT, give me the 10 stocks that are going to make 100% in the next year, which is a terrible prompt, obviously, because AI wants to please me, so it's going to give me an answer. But that answer is based on let's put it this way, not a complete question. So the deeper you go into explaining exactly what you want, the better the output is. And there still comes, what you see is that skill of asking the right question is so important. And that's the same for my system development. The better I ask the question, what do I want from my strategy, the easier my development process is. So the better I ask AI, what is it that I want, the better an answer it gives me. But it speeds things up phenomenally. But I know that people were back in the 90s, they already had like neural networks and stuff like that, and it never really worked. So it's I don't think that suddenly there's going to be an AI program that can look at an equity curve and that can learn from that equity curve, knowing what the price of tomorrow will be. I don't believe in that. What's your thought on that?
I think just as you said it, AI is a tool that when you give it the right input, it can help speed up everything, research,
Phenomenal.
coding, all of
Yeah.
that. but it's going to be a tool that we use, and then we have to step back and like have the forethought, judge their answer, see if we want to take it in a different direction. It's not going to be just a magic bullet that puts us out of a job. We have to use it correctly, I think is the right way to think about it. Yeah.
And revise the answers as well, but also revise the code as well, because it just comes up with a code, and having the assumption that the output of AI is correct is not 100% correct assumption yet. It's getting better, exponentially better. It's fascinating. I use it in a lot of parts of my life right now, and it's something that will be integrated in my software as well, deeply. But it's still something where we need to see, like, okay, is it actually doing what I want to do? So yeah, it's fascinating.
Yeah, and what you said about it wants to please you, that's something to always keep in mind, because it can give you, amazing response, but it can be completely false still to this day. So I think that's definitely for everybody. Make sure, there's the phrase trust but verify. I don't know even if you trust it, but definitely verify it for sure. Um,
I've had
Fantastic.
large arguments with certain AI programs where I said, like, listen, this is just completely false. Don't lie to me, please.
The chess, of course. Lawrence, I'd love to come back to the precious metal trade in SLV, which you mentioned earlier. Um, could you break down maybe for us the strategies that were involved in the precious metals that you run, and how they were kind of how they traded it, basically? If you have a long strategy, I'm sure that was involved, and then maybe at the end you had a mean reversion strategy that kicked in. Could you break that down for us, that situation, and how kind of your strategies were involved? That'd be really interesting.
Mainly trend following,
Hmm.
not that much mean reversion on precious metals. And what I like to do on the trend following part, both long and short,
Hmm.
is on the long side, I really like to scale in. So one tranche, a third, 50-day Keltner channel with +1 ATR. Second part, 100-day +1 ATR. Third day, 150 +1.5 ATR, more or
Hmm.
less. And then you have trailing stops as well. One is a little bit shorter than the other one. So obviously that was a huge win for all platinum, palladium, silver, gold, all of them in 2025, and then December and January, it was getting completely nuts. On the short side, I have one strategy that has an intraday order that shorts the commodities when it goes below the 10-day exponential moving average +1 ATR. So that means that regardless of what, you will give a little bit of money back after such an exponential move up. But it took a lot of the risk away quite early. I think another thing that is incredibly useful is there's two things that I would say that people could use. Um, the first thing is what Tom Baso obviously does, and he's spoken about that with you, I assume, that he scales out of position when the risk of his open position exceeds the risk of his initial position, right?
Right.
And he's done that, and that meant that his ride was certainly smoother. You still also give back money when it suddenly starts to drop. I think another interesting thing is, if you want to be a little bit more single system minded, what some people do is, like, okay, let's say a strategy has, it's a trend following strategy and it has a 25% trailing stop. You could have a rule and you say when it's up more than 100%, You tighten the trailing stop by 50%, making it a 12.5% trailing stop. That does not protect you, obviously, from gaps and stuff like that. But it is a way to lock in more profit, basically, which for many people on a psychological level is something that is very, very comfortable.
Yes, for sure. Lawrence, this has been fantastic. I love hearing your perspective because it's so different than what we do, but there's lessons that we can apply to what we do as well. If you were starting out today, what would be kind of the resources that you would point people towards if they're looking to learn systematic trading, and definitely, you know, mention your books in there as well as any other resources that you find very valuable?
I think the Market Wizards book that talk about systematic trading are always interesting. My book, Automated Stock Trading Systems, is probably the way to go. Tom Baso's book, The All Weather Trader, definitely something that you want to do. I think there's a free course on my website, tradingmasteryschool.com, that you get a lot of other systems as well, completely free. I think as long as you have a good understanding of indicators, but also have the awareness that the indicator is not magic or anything, what you want to start to do is actually put things into practice.
Try it out. Yeah.
And try to see how far you can come with the skills that you have, because you can educate yourself for another 10 years, but eventually the fundamentals are keeping the same. So reading those books and then taking a step of action that is according to what your lifestyle, your skill, and your finances and your time permit for you. You know, if you're 18 years old and you don't have a lot of money, but you are very comfortable with programming, go ahead. Go for that whole route. That's what many people do. If you're 55 or 60 years old, understand the concept, that you might look for another solution.
Yeah. Excellent.
There's so many solutions.
Yeah, for sure. And one actual last question I wanted to ask you, and be interested to hear your perspective as a systematic trader who oversees all these different systems. How would you define risk in the markets, and I guess trading at large? And what do you do to manage that risk?
I think risk is the most important part to be aware of in trading by far. You can have brilliant strategies. You can be a brilliant trader. But if you overestimate your risk, your greed, or your confidence of the potential returns that you're going to have, the market is going to catch you. There's no doubt about it. So the first thing we want to do is think in risk terms. Then we can see what the potential returns are that we could get. So if I take a look at myself, when I started my systematic trading journey in 2007, I had a small account. And I paid at that time, I paid more on programmers, on software, on consulting fees and stuff like that than actually my account was. But it was for me all to get the training and the knowledge and everything. Yep. But at that time, yeah, if I had a 30-35% drawdown, didn't bother me that much. Was it nice? But okay, it's not a big deal. Right now, when you trade an account that is so much larger, um, although from a mathematical standpoint of view, thinking in percentages is still getting you the highest outcome. But from a rational standpoint of view, it just doesn't work like that. You know, when you suddenly have an account of, let's say, $5 million, and you have a 35% drawdown, you're not gonna feel very nice about that.
Yeah. And if
Uh,
you're someone
but
who's going to be retired and built up this nest egg, you can't have that type of drawdown. Sequence of returns matters
exactly.
even more as you grow that
Exactly,
account. Yeah.
because it could suddenly mean that person that risked too much actually at 70 years old needs to go back to do some partial consultancy work because he cannot live off his income anymore or her income anymore. Um, on the other hand, if you aim, let's say, very defense, very low risk, which is what I am, which I think is something that is very comfortable if you've got a larger account, because what you focus on, it's the law of compounding, basically. If I get a 15% compounded annual growth rate, every 4.7 years, I double my money. And if I at the same time, I can get my drawdowns below 10%, I sleep so good, you know? And that's the part where you're completely serene with your trading and there's zero stress in there. Does that mean that you get it to $1 billion? Most likely not. But will it increase the likelihood of a very nice retirement, stress-free, and accumulating your wealth? I think very high. And that is eventually what counts. And I think, I don't know who asked it, but somebody asked it to Warren Buffett. And it was a question like, why don't do more people do what you do? And his answer was like, most people don't like to get rich slow. And that is very, very true. We get impatient sometimes. We want to be there immediately where other people are. But the law of compounding does the work for you. And if you have a good stock of money already, be careful with your money. If you're young, totally fine to be a little bit more aggressive. It also
Yeah.
has to do if you have any other side income. If you have
Yes.
zero side income, you're going to look a lot more at your portfolio. If you have some other side income, it's a little bit easier, obviously.
Yep.
But
Excellent.
risk, it's the one thing that I've seen that people so much have it wrong. And I always say, think of a number of a drawdown that you can handle, and I can guarantee you, put that number in half. And I know that many people have said that before, but I've worked with many students and I've seen it happening actually. It's so comfortable if you're well within your drawdown tolerance to trade like that.
Yep. Excellent. Well, Lawrence, this is, like I said, it's always so great to chat with you. Do you have any other advice for traders out there who are watching this? Any kind of last messages that you'd like to, leave everybody with today?
I think I always had the advice about risk management. So that is exactly the question that you asked me. I probably would want to finish regarding the risk as well. The key thing is that you want to stay in the game.
Yes.
If we have a strategy that has an edge that we can make money, our biggest risk is that we don't have any chips left to actually execute our strategy. as long as we have chips left because we look at our risk tolerance, then we look at the longer term outcome. And that is all what matters.
Excellent. Well, Lawrence, thank you so much for your time. I really enjoyed this. To everybody watching, I hope you did as well. Leave a like down below if you did. Subscribe to the channel, and we'll see you guys in the next one. Cheers.